Hi, I'm Brent Leadbetter. I'm a member of the distributions team here at Research Affiliates, and I'm going to be talking about the risk component of our tool on the Asset Allocation Interactive, specifically via what we refer to as the Analyze and Compare button in the lower right-hand corner of the screen. But before I get there, I'm going to cheat a little bit, and first I'm going to spend a little bit of time talking about return. I think the return is probably what most people come to our capital market expectation site for first. So I don't feel bad about cheating and looking at returns to start as my segue into risk. What I'm going to start with is trailing returns. You see this drop down box where we can toggle between expected or forward looking returns versus trailing time periods. So I'm going to start with trailing 10-year returns. The reason I'm going to do this is because I want to isolate US large equities. Many of us know that they've been a bit of an outlier, or a bit may be an understatement. They've been a dramatic outlier over the past decade. As we see, US large equities have generated a return of more than 12.5% per year for the entirety of the preceding decade, well above any other broad asset class. In fact, you see that the next closest asset class or portfolio that I'm listing here is local 60/40, which for a US based investor, someone in the States like myself who has USD listed as their currency, local 60/40 is going to be US 60/40. So on a trailing basis, the returns have been phenomenal. But where we're interested, when you're looking at building an asset allocation, you should be more interested in forward-looking return and risk as opposed to trailing return and risk. So I'm going to stick with this local 60/40, but I'm going to toggle to expected 10-year return. When I toggle to expected 10-year return, you see I get this option in the lower right-hand corner of the screen called, again, Analyze and Compare. And this is what lets me dig a little bit deeper into the portfolio. So right off the bat, I see the weight, and it's a 60/40 portfolio. So unsurprisingly, the weights are, well, they're 60 and 40. You see the contribution to return, and pretty straightforward. But what may be of interest is we also show the contribution to risk. And the reason I want to start with US 60/40 and looking at this risk decomposition tool is highlighting that while US equities are only 60% of the total allocation in a 60/40 portfolio, they represent more than 90% of the risk. The total volatility of this portfolio, expected volatility of a US 60/40 portfolio, is almost exactly 10%. 9.9% annualized vol is our forecast. 9.2 percentage points of that total are coming from equities alone. The bonds are representing, well, 40% of the total allocation, less than 10% of the total risk. And so I want to highlight this again, starting with a 60/40 focus, because given the trailing strong returns for US equities, I think a lot of investors are focused on US equities and focused on a 60/40 portfolio as their go-to, if you will. So when we click the compare to this drop-down box, we get a number of options. Other base level percentage allocation choices. We also have conservative, moderate, aggressive, all equity models at the top. I want to start with the moderate model. This is a broadly diversified model portfolio that we've put together for US financial advisors and US based investors that is designed to maximize return for a given level of risk, assuming some reasonable constraints and caps on allocations. So our moderate portfolio is targeting around a 9% volatility measure, around 9% risk, annualized standard deviation of returns, with some constraints such as, we've got commodities and tips listed here. We're not going to let commodities and tips be 40% of the portfolio, for example. For lack of a better term, we're not allowing, quote unquote, weird allocations, right? You're getting mainstream allocations within those constraints, looking to maximize return. And so starting with US 60/40, we see a return expectation of around 4.5%. This may be lower than a lot of you might expect. The reason for the low return assumption is because of how expensive US equities are today. With the Shiller Cape north of 30, the return assumption is relatively modest for US 60/40. specifically given how expensive equities are. If we move to our moderate model, we see an increase in return expectation of nearly 3 percentage points, along with a reduction in risk along the lines of roughly 1 percentage point. And not only do we see a reduction in risk, but we see the sources of risk are substantially diversified. Whereas US large equities represent 9% of total risk in the 60/40 portfolio, US large equities decomposed into growth and value in the model represent less than 2.5 percentage points of the total risk contributed to the model portfolio. That said, you don't have to look solely at the models that we're recommending. You can go a step further and you can compare to an even more broadly diversified portfolio, what we're abbreviating to liquid EW10. This stands for an equally weighted basket of 10 liquid asset classes. Because it's an equally weighted basket, as you see, they're literally 10% across the board to 10 different asset classes. Importantly, if you go with this even more extreme level of diversification, what I would refer to as really sort of the epitome of broad diversification in a liquid-only public market context, what you see is this equally weighted basket of 10 asset classes also achieves a risk reduction relative to US 60/40 while still increasing return assumptions. Again, this idea that because US equities are expensive, because they're representing an outsized share of risk for US 60/40, the more diversified you can get, the more you can spread your exposure out and be less reliant on US large equities alone, the better. But regardless of specifically where we're at today in early 2024, I think this is a fun tool because it lets you dig into portfolios that you create, see not only how much different asset classes are contributing to return, but also how much those different asset classes are contributing to risk. So with that, I hope you found this brief demo, this new feature to be really helpful. Thank you very much for your time.